I can hand you a coin that is genuinely rigged in your favor. It lands heads 60% of the time, and it pays you even money. That is a real, provable edge. And I can still watch most people take that coin and go completely broke. Not because the edge failed, because of the one number nobody checks: how much you bet on each flip. Today, I want to make that number feel obvious so you never forget it at the screen. Quick and important. This is educational commentary, not personalized financial advice. I run an options book, I day trade SPY and QQQ, and everything here is a way of thinking, not a signal to copy. Why does this matter now? Because retail traders are more levered than ever: zero-day options, prop firm challenges, 5x crypto. Everyone obsesses over finding the edge. Almost nobody does the math on the thing that actually decides survival. Get the edge right and the sizing wrong, and the market takes you out anyway. Here's the misconception, and it's a comfortable one. Traders believe that if a bet is positive expected value, it's safe to size up that bigger edge plus bigger size equals more money. So they reason, I win 60% of the time, I should press hard. Let me show you exactly where that belief breaks, using nothing but our coin and $100. Start with $100. The coin wins 60% even money. Your expected value per flip is positive. On average, you make 20 cents per dollar risked. That is a fantastic edge, better than almost anything in real markets. So let's be aggressive and bet the whole 100 every flip. Flip 1 heads, you have 200. Flip 2 heads, 400. You feel unstoppable. Then tails, 0, game over. The edge never got a chance to work. That's the trap in its purest form. With a 60% win rate, a losing flip isn't rare, it's 4 out of 10. Betting your whole stack means you only need to be unlucky once, and one is basically guaranteed. So the fix seems easy: don't bet all of it, bet a fraction. But which fraction? This is where the survival math lives, and it's more surprising than you'd think. Let's bet a fixed fraction of the bankroll each time. Say 50%. Now a loss can't wipe you out in one shot, but watch what compounding does. Win then lose, 100 goes to 150, then down to 75. You won one and lost one, you were right half the time, and you're down 25%. Every win-loss pair shrinks your money by 25% even though the coin is in your favor. That gap is called volatility drag, and overbetting turns your edge into a slow leak. So there are two ways to die. Bet too big in one shot, and a single loss ends you. Bet a large fixed fraction, and volatility drag bleeds you out over many flips even while you're winning. Somewhere between reckless and timid, there's a size that lets the edge actually compound. The tool that pinpoints it is called the Kelly criterion, and you don't need the derivation, just the intuition. For our coin, Kelly says bet a fraction equal to your edge. 2 times 0.6 minus 1, which is 0.2, 20% of your bankroll. At 20%, your money grows fastest over the long run without courting ruin. Notice something. Full Kelly, the mathematically optimal growth bet, is still only a fifth of your stack for a monster 60% edge. If the theoretical maximum is 20%, what does that tell you about the person risking 50% of their account on a single trade? Here's the part that reframes everything. Betting more than Kelly doesn't just add risk for extra reward past the optimal point. More size gives you lower growth and higher risk of ruin at the same time. You're taking on more danger to make less money. That's the sentence to tattoo on your brain. Past a point, bigger bets lower your returns. Size isn't a dial from safe to aggressive. It's a hill. Climb past the top and you're falling down the other side. Now transfer this off the coin and onto a real screen. Say you trade SPY options with a genuine edge. Your setup wins 55% of the time with decent payoff. That's a good system. But if each trade risks 30 or 40% of your account, the risk of ruin math says a normal losing streak, and 5 losers in a row happens all the time at 45% loss rate draws your account down so far it can never recover. The edge was real. The sizing killed it. This is why most funded traders blow the account, not because they can't pick direction. And risk of ruin is brutally nonlinear. Cut your bet size in half and you don't have your chance of ruin. You often cut it by a factor of 10 or more. Double your size chasing a fast recovery and the probability of ruin explodes. That asymmetry is why professionals sound boring. Risking 1 to 2% per trade isn't timidity. It's the number that keeps you at the table long enough for a 55% edge to actually pay you. So what does a disciplined trader actually do? First, they size from the downside, not the upside. They ask how many losses in a row they can survive before deciding how big to bet. Second, they usually run a fraction of Kelly, a half or a quarter, because your real edge is always smaller and noisier than you think, and half Kelly keeps almost all the growth with far less drawdown. Third, they treat position size as a fixed rule set before the trade, not a feeling adjusted mid-trade when they're down and want it back. Here's your durable handle, the line to resay at the screen. Your edge decides whether you win, but your bet size decides whether you survive to collect it. A positive expectancy is worthless if a routine losing streak ends the game. If this is the kind of math you want made obvious, signal, not hype, subscribe, because the next one breaks down what the options market is actually pricing before earnings. So before your next trade, don't ask how confident you are. Ask what happens to your account after 5 losses in a row, because at any real win rate, that streak is coming. Answer that honestly, size for it, and you turn a fragile edge into a durable one. That's the whole game.